Stocks are crashing. I'm your host, Steve Metre, and thanks for joining me today. And a week ago, we outlined a nightmare scenario where the machines would start selling during the corporate share buyback blackout period. And sure enough, it started. Let's over to Goldman to find out just how low stocks can go. And Goldman Sachs headlines today that higher rates, lower valuation, is reducing their S&P 500 year-end 2022 target to 3,600 and exploring scenarios for an even deeper cut in 2023. The expected path of interest rates is now higher than we previously assumed, which tilts the distribution of equity market outcomes below our prior forecast. The S&P 500 index actually reached our previous year-end target of 4,300, which clearly means that Goldman didn't aim low enough in mid-August, but the rate complex has subsequently shifted dramatically. The higher interest rate scenario that we now incorporate into our evaluation model supports a PE of 15 times and implies a year-end 3-month S&P target of 3,600. Well, and with the rate that stocks are heading down today, Goldman might be needing to revise that number here again soon. And a 6-month and 12-month forecast of 3,600 and 4,000. Equity valuations have closely tracked real interest rates until recently. Real yields have soared from 0.4% to 1.3% during the past month and could reach as high as 1.5% by year end. And for context, real yields were negative 1% of the start of the year when the S&P 500 index hit an all-time high of 4,800 and traded at a PE ratio of 21 times. Now, why do real yields matter? Well, it's because when real yields go higher or inflation-adjusted yields go higher, investors start to look at the risk of the equity market and see opportunities in bonds. And with interest rates pretty high right now, well, that makes the case for why stocks are heading lower. And let's take a look at this chart to see why Goldman's case on this is right. Here you can see in real yields in blue, and notably we're going to go back to the great financial crisis, and we have overlaid the Wilshire 5000 price index, and you see here real yields going higher and stocks heading lower as investors start turning to the bond market, which eventually sent real yields down. And here we see that again today. Real yields are rising, making bonds an attractive alternative to stocks. The outlook is unusually murky as a forward pass of inflation, economic growth, interest rates, earnings, and valuations are all in flux more than usual with a wider distribution of potential outcomes. But I absolutely disagree with that. I actually think we do have a good idea of what's coming, and we'll take a look at some charts here momentarily to see where I think things are headed. Based on our client discussions, a majority of equity investors have adopted the view that a hard landing scenario is inevitable, and their focus is on timing, magnitude, and duration of a potential recession and investment strategies for that outlook. Well, let's see if indeed the outlook is murky. Well, we know where inflation is headed because we talked about this in yesterday's show. Here we'll look at that same chart with the consumer price index against U.S. regular all formations gas prices, that shown in red, both on a year-over-year rate of change. Notice the strong correlation between the two, indicating that as gas prices head lower, that means inflation is set to fall. But that's not the only case for lower inflation, which again is not a murky subject, because now we've got the University of Michigan inflation expectation. So what consumers think, and notably this too is tied to gas prices, we see it rolling over, and we won't get the latest update on this until next week. But of course it indicates that what's happening is inflation expectations are rolling over. They're going to start heading down, and that will bring the consumer price index lower with it. And it's not the only thing that we can say that will drive inflation lower. The stock market is a fantastic barometer of future inflation. Here we can see, with some exception, only a couple times in history, but now we have the Wilshire 5000 shown in red, it too on a year-over-year rate of change. And we can see as the equity market heads lower, that usually leads to less inflation. Again, less demand, but there are a couple times where we see inflation rising as the market's falling. And what happens? Inflation comes crashing down, inflation comes crashing down, and you can guess what's coming next. Inflation is coming crashing down. But how about the economy? Well, we kind of know where it's headed to. And here we can see the current new orders diffusion index for the Philly Fed, and it is telling us that new orders are contracting. Below the black line means that new order growth is falling, and we note that the Wilshire 5000 price index again is telling us that as demand falls, as stock prices fall, demand for the economy and new orders, its too is going to head lower, suggesting that indeed we know what the path for the broad economy is, and that is lower. We can also tell where earnings are headed, not because we have the data on earnings from the Fred database, but we do have profits, which are just as good. And what do we know? That when stock prices head down, here we have the Wilshire 5000 again, now overlaid against corporate profits after tax, it too on a year-over-year rate of change. And what do we know? Where the stock market goes, profits will follow. And what about the bond market? Well, everybody thinks interest rates are only going to go up, but notably they do have a relationship with the broad equity market. When the stock market on a year-over-year rate of change is headed lower, yields usually follow. But there's a couple outline periods where we see in red the stock market headed lower and yields rising, just like we're seeing now. We see that in two instances here, kind of in the mid to late 80s. We see that again in the early 90s. And what happened after that? Yields came crashing down. Yields came crashing down, and here we see it again in 2018. Yields come crashing down. All it's telling us is the likely path for interest rates is lower, not higher. We previously published that a recession falling S&P 500 EPS could cause the index to decline to 3150. An 11% drop in earnings per share would be consistent with modestly negative real GDP growth and the 13% median earning per shares drop during prior recessions. Under a hard landing scenario, the yield gap would rise, and the 3, 6, and 12-month targets would be 3,400, 3,150, and 3,750 on the S&P 500. But one thing that shouldn't have a hard landing, if Goldman's right, is that's your portfolio. I'll put a link up here to Portfolio Shield and a description below, because what they're not factoring is a global recession. In the near term, investor focus will soon turn from valuation to earnings, mainly because earnings season is about to start. The surprisingly high August inflation reading was a pivotal event for macro investors regarding the path of Fed hikes. The analog for stock investors now is third quarter earnings season, where record high profit margins will be under scrutiny and are likely coming down. And we can make that case very simply by going back to that new orders data from the Philly Fed. And yes, it is noisy. You see it oscillating up and down. But when we overlay corporate profits, well, as you can imagine, as new orders head lower, well, profits tend to fall. And why does that happen? Is because goods get stuck on shelves. They can't get moved. And that means new orders get canceled. And that means markdowns come. And those markdowns cut right into corporate profits, telling us we already know that the outlook for the third quarter and potentially even the fourth quarter are going to be bad. And if only this can recover quick enough, maybe things can turn around by early next year, but we'll keep on touching the data, because if it doesn't, then that first quarter is not going to be pretty either. Given this balance of risk, we lower our year-end 2022 S&P 500 price target to 3,600 again, which I think they might be revising even lower. In the next recession, we forecast earnings will fall, the yield gap will widen, pushing the index through 3150. Our economists assign a 35% probability of a recession in the next 12 months and note that any recession would likely be mild given the lack of major financial imbalances in the economy. But what Goldman can't see, and what a lot of people can't see, is part of this nightmare scenario that's unfolding is we're heading into a global synchronized recession. And to that, we look at the preliminary Purchasing Managers Indices data, which we got today. It was started out last night with Australia. Note that when you see a 50, it's unchanged from the month before. Over 50 denotes an expansion. With the higher the number, the greater the expansion. And below 50, a contraction. The smaller the number, the bigger the contraction. How about Australia? Manufacturing sector just increased slightly, 53.9. How about the services sector? Stall speed, not moving at all. How about we head over to the Eurozone? Let's look at France. Their manufacturing sector is contracting. How about their services sector? Slightly growing, but likely to change in the coming months because, well, look at Germany. Their manufacturing sector continues to contract. Their services sector is in a deeper contraction, putting the broad Eurozone. Look at that. Manufacturing PMI 48.9. It's telling us Europe is contracting. No surprise with what's going on there. Their services sector at 48.9. It's continuing to contract. contract. Remember, we talked about this notion that this pendulum swings, and when it gets out there, it starts to come back, and we're starting to see the beginning part of it coming back down. That means it's going to accelerate to the downside. How about Great Britain? Their manufacturing sector, it too contracting, services slightly contracting. Now, let's not leave out the U.S. The manufacturing base expanded just a bit faster, but not much. It's still showing it's just above stall speed. But how about the services sector, which notably had a pretty sharp drop last month? Well, at 49.2, it says virtually no change. That the services sector in the U.S. is still now slightly contracting over last month's already contraction that it saw. For context, a 34% peak-to-trough decline in the S&P 500 index during a recession would only be slightly worse than the historical average of 30%. They see two risks. One is inflation. Second, concentrated sector weakness, overlooking the case that I just made, and that is a global recession. But what about their year-end target? Well, they still think the stocks could rally back to 4,300 if inflation shows clear signs of easing, but it seems that that is just a mere fantasy. In a follow-up to yesterday's story, Japan has a pile of dollars it can tap before selling securities. Before selling Treasury securities, that is, a headline to Bloomberg. The Fed's creation of a reverse repurchase agreement facility that's accessible by foreign central banks means that international monetary authorities, such as the Bank of Japan, can keep a big chunk of their cash there earning interest instead of in Treasury bills or other securities, meaning that, yes, we are paying interest on the Bank of Japan's dollar deposits at the Fed. While Treasuries did sell off on Thursday in a bear steepening move, participants point to an ongoing digestion in the market of the Fed policy message from a day earlier as being a significant driver rather than any particular liquidation by foreign holders. As with the domestic reverse repo facility, the so-called foreign reverse repo is a place where counterparties can stick their cash overnight with the Fed. And we don't want to wrap up without seeing our chief strategist, Jeff Snyder, who comments on the same topic of Japan. With this note, in his daily, relatedly in Japan, authorities there intervened in the currency exchange market today for the first time since 1998. Another important, if the wrong kind of milestone, one which indirectly implicates the seriousness of the euro-dollar situation or global dollar shortage, which is actually behind all of these currency dilemmas. Either way, he notes that with outflows accelerating, these are together an ominous warning about the deflationary circumstances across the entire euro-dollar's reach, and one which will be laid directly and incorrectly at the feet of rate hiker Jay Powell. Hey, how about that? And so now you can see the nightmare scenario is folding out, and we note that with corporate share buyback blackouts continuing to increase, downward pressure on the market is going to get even faster as investors eventually start looking at their statements and trying to turn and hit the sell button. It's coming and only likely to accelerate as we head into next month. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.